and what's shaping automotive supply chains for the rest of the year, 2022, and all time to come. I'm Rich Logan, Senior Content Producer at Automotive Logistics and Ultima Media. And skipping lunch so he can join me on stage is Brandon Mason, Lead Analyst, Global Market Intelligence at Eaton. Brandon has been sharing his insights on production and sales forecasts, analysis, crystal ball gazing, and much more with our audience for a number of years now. And he's never once been wrong. So I hope you have your pen and paper ready to take down everything he says. We'll run through some production numbers, some outlook numbers, insights, followed by a short Q&A. So without further ado, I want to hand over to Brandon.
Thanks, Rich. Good afternoon, everyone. First, I have to say it's great to be back live in person. Although to those joining virtually, I'm quite envious that you get to still sit in your sweatpants. That is something that I did enjoy during the last 18 months or so. So as always, there's a lot to talk about in the industry right now. I've got about 15 to 20 minutes to try and wedge it all in. So I'll try and keep my topics focused on the current chip issue and kind of where we see that going, and then what to expect once we get past this issue into 22, into 23, and sort of the rise of vehicle electrification and the impact that we think that'll have on the industry. So we'll jump right into it. I thought it would be prudent to start off by giving everyone an update on the global chip impact. So this is from IHS. This actually shows year-to-date the announcements that all the OEs have made around the world, and then the subsequent chip impact. Obviously, it's a little bit of a guesswork because we're sort of backing into it, right? An OEM will announce downtimes. We take a look at the capacity and build per day at each of those plants to kind of back into these numbers. But you can see it's pretty dramatic, right? As we stand here today, just the number of announced units lost is estimated to be at about 8.2 million. And you can see the spread by region there. North America currently leads the pack. It's not a race you want to be winning. 2.2 million units of impacted production. EMEA and APAC are each at about 2 million units apiece. China at 1.5 million, and South America at a little under 500,000. So a couple things to dissect there. First off, when the chip impact first started, we were wondering why China didn't have as big of an impact as others. They've now sort of caught up to that, and in fact, we think their Q4 could very well be worse than Q3. We're hopeful that that's not the case for the rest of the world, that we'll start to see some levels of stabilization this quarter. That doesn't mean we won't have any more downtime announcements. We certainly will. And again, if you look at the Q4 numbers here, these are only what has been announced. We expect more to come in the weeks ahead. And then South America, the dynamics are a little bit different, right? The requirement of chips is much less than other parts of the world where you have more, let's call them more high-tech advanced vehicles. IHS has said, with the revised forecast this month, that we could see an impact of up to 10.5 million units. For their part, LMC, another forecasting house, is predicting about 9.2 million units. Like I said, we're at 8.2 today, so we could see another 1 to 2 million units or so impact here in the coming weeks. Again, hopefully we'll see some stabilization, and that'll put us in a good position heading into 2022. But just to give you a brief update of where we sit today. So, of course, throughout this journey, we've had a number of things that have popped up that have had a negative impact. I'll talk here in a minute about how we got to where we're at and the things, sort of the perfect storm that occurred to get us to this point. But I wouldn't even say this is the latest, right? Because as most of you know, there's ongoing developments in China right now where there's restrictions on some of their manufacturing facilities to sort of curb emissions. But Malaysia, let's call it, was one of the more recent things that have really changed our outlook, or changed our outlook on Q3. I think a lot of folks thought that Q3 would at least be incrementally better than Q2 in terms of the number of vehicles impacted. Turns out that wasn't the case. The biggest driver, as you can see here, was Malaysia, who's responsible for 13% of global chip production globally, global chip production. their COVID cases spiked, and that's happened in different parts of the world. If you look at the number of cases, they're basically on par with Japan. The problem is Malaysia is 1/4 of the population of Japan, so the government was forced to enact some pretty strict lockdowns, which included a lot of the manufacturing facilities that build those chips. And so that was something that obviously we weren't fully expecting as an industry, but now here we are. There's still issues in Malaysia. We think they're going to slowly start to ramp back up some of that capacity, but they're not going to get back to full capacity. Probably not this quarter, probably not until 2022. Number of companies, this is a non-exhaustive list, of course, but I think what's interesting is if you look at the quote on the top right there, it's from the president of the Malaysia Semiconductor Industry Association. He said, the automotive industry came to us in January and said, hey, just kidding, like we would like to get some more chips now, please. And they said, sorry, right? Take a number. Because it's not just the automotive industry that's impacted by this global chip shortage. There are other factors at play which, as an industry, we haven't always had to deal with, right? Obviously, we deal with multiple sectors, there's overlap and things like that. But for many things, we felt a little bit siloed, right? This impacts so many other sectors and so many other industries. And I have to say, we're not always the first priority when it comes to the chip manufacturers, whether it's just the margins or some of the newness of the customers. If you think about the number of chips that are needed in electric vehicles, which could be up to 10 times the amount that are found in a combustion engine vehicle. So there's a lot of dynamics at play. But long story short, this is not something that we can just flip a switch and correct or pay more. Capacity is limited in this case. And we're working to increase that, but we still have a ways to go. So the next slide kind of highlights a little bit how we got here. And the table was based off of a report from Gartner back in March. And I thought it was really interesting because I think for a lot of us in the auto industry, as the semiconductor issue started to bubble up, a lot of us were caught not only flat-footed, but like, what does the semiconductor supply chain even look like, right? What is global capacity? We've got a good handle on a lot of things. And then this industry comes to find out that like the semiconductor thing was not really one of them. So without rehashing too much of the past, how did we get here, right? So this whole thing started back in, call it mid-2020, right? So the pandemic had taken hold. We had lockdowns everywhere. Folks were sitting at home. And somebody or a group of people incorrectly assumed that demand for certain products would go down because we're in the midst of a global pandemic. Everybody's hunkered down. Well, the exact opposite thing happened. Right? I don't know about you guys, but when I was sitting at home at my computer, I'm like, oh, I'm going to buy some more stuff. Right? So people are buying PlayStations and Xboxes and iPhones. And so this demand for chips, in fact, didn't go down. It spiked. And the industry wasn't ready for it. And again, within the semiconductor manufacturing footprint, it's not something that you could simply turn on a switch and say, okay, now let's go make more chips. It's a much more labor and time-intensive process than a lot of people figured. And then we moved into the fall of 2020, and there was a fire at a plant in Japan, Renesas, which is one of the major production hubs of global chips. So that took a lot of that capacity offline. And if anybody's seen the photos of that, it was a near total loss, right? That plant is now just coming back online, or came back online, I think, in June, back to full capacity. Then fast forward to February of this year. Storms in Texas. Talk about a perfect storm, right? A lot of chip capacity down there, as well as we had issues with resins. Took a lot of that capacity offline. And then we have the issue that I just mentioned in Malaysia. So what does all that mean, right? What's interesting here, and this chart's a little busy, so let me just try and explain it. The dots that you see there, those colored dots, that is a percentage of global chip capacity compared to what we had pre-pandemic. So call it January 1st, 2000 was 100%. And so you can see the impact that those things that I just described had on our top line capacity as an industry. So we're starting to ramp back up that capacity, and we're getting close to pre-pandemic capacity. But the only issue is demand, which is the dotted line there, has continued to increase, which is good in some aspects, right? Vehicle sales, demand for electronics, overall economic fundamentals, they're relatively strong. But that's creating a continued gap between supply supply and demand. And so there's been a number of new announcements for this chip capacity. There's at least a half dozen companies, if not more, that have announced investment to build new capacity. But these plants are extremely cost prohibitive, even compared to an automotive plant, and they take a long time to build. So we don't see that new capacity coming online until probably Q2, Q3 next year. So we think for at least the first half of next year, you're going to have continued constraint in the marketplace. I think a lot of people originally thought, well, again, let's just turn the page, right? This will be over 2022. We can get back to business as usual. Demand's high. Let's crank out a bunch of vehicles. It's not going to be the case. And what we've realized over the last year and a half is anything that can go wrong likely will go wrong. And so, we don't know what else could happen between now and then. Again, I just mentioned the issue in China. There are other issues that could pop up that could handicap this growth ratio. We also have a number of unfinished vehicles in the world. In the North America alone, we think there's around 200,000 vehicles that aren't finished, that are sitting in staging areas that are waiting. In most cases, they're waiting microchips, right? But other elements as well. I'd also, and I don't have any of my comments here, but since commercial vehicles make up about half of our business within Eaton's vehicle group, the commercial vehicle side of this is impacted as well. You heard one of the earlier panels talk about the inability to refresh Class 8 stock and get new vehicles because capacity constraints are there as well. Not as much in terms of a volume basis, but it's impacting the ability for the industry to ramp back up. Orders are getting pushed into late 22, in some cases into 23. So this is sort of the near-term outlook in terms of how we see things playing out. So it's probably not going to be to the end of next year or early 23 until what we think a normalized level of supply and demand. But again, you have to take that with a bit of caution because anything could happen between now and then. Okay, so what are some of the other impacts that we've seen? One of the dynamics, production versus sales, right? And I'm going to focus on North America in the US, but what I think is interesting is that the long-term impacts that we could see in terms of inventory levels. So I think most people know in the room that the US has traditionally had a very high level of inventory compared to other mature markets around the world. If you look at Europe and the model they have there, it's pretty much a build-to-order model, right? You don't have millions of units of inventory just laying around for a customer to go in and say, I want that one, and you drive off the lot. We were lucky in the early days, as you can see here. If you look back to the start of the pandemic, March of last year, our inventory was about 3.8 million units. Look where it's at today. It's less than 1 million units. That represents a 24-day supply. That's a record low by far. So we were lucky, again, early days, that we had inventory to draw down as these plant and downtime announcements continue to pile up, that we had inventory. Now we don't. Anybody that's driven by a car dealership knows exactly what I'm talking about, right? It's slim pickings. And those million units that are left, I'm guessing that they're not a bunch of full-size SUVs and pickups. You know what I mean? So the question I often get asked is, well, what's the new normal going to be for inventory? If you look at Europe, and Europe doesn't have inventory numbers, but we know it's significantly lower than this. If you look at China, they have an inventory index, and it's at a 2-year low right now. So my answer is, I don't think that we're going to get back to a level where we were at previously, where we had, realistically, it was a 90-day supply if you're talking about an annualized sales of 16 million units. But I don't think we're going to quite go to the European model where it's built to order, right? We have a pretty significant dealership infrastructure here in the US and in North America. So it's probably somewhere in between. So do you get back to 2.5 to 3 million unit inventory level? But that's still a lot to build up. So let's just say, for example, we go say the new normal is 2.5 million. That's 1.5 million units of inventory we need to rebuild. And that's, if demand cools, okay, that's fine. Then we can still keep the plants running. We also have vehicle fleets, rental fleets, municipal fleets that need replenishing as well. So the good news is, even if demand cools, we're still going to have to be able to build up this inventory. If demand stays hot, well, we're going to be in a continued crunch, aren't we? So anyways, I thought it was interesting to kind of see like where we see inventory going in the near future and the impact that it'll have on production. The other thing I'll mention up at the top there is that's just the gap between production and sales. So it's not totally abnormal. We generally have more sales than production because we're a net import market. But just if you look over the last few quarters, that gap has continued to widen. And that's been the case across the world as well. That gap between production and sales has continued to increase. Okay, so let's take a look at it from a global level then. and what the impact is. So last year, sales or production was down about 16% globally. And we finished the year really strong, right? Certainly during the early days of the pandemic, and I think when we spoke around this time last year, we were wondering how bad it was going to get. We hadn't quite turned the corner yet. But Q4 was very strong last year from a production standpoint. So we finished the year a lot better than I think a lot of folks anticipated during the depths of the recession. So down 16%. And again, this year everybody thought, oh, we're going to get it all back and then some, right? Because we've got all this pent-up demand. Nope. Production, according to IHS, is going to be up about 8% this year. That'll get us back to 81 million units. And now next year, which is interesting, and I think the growth projection is about 12% growth year over year in 2022. But a lot of that growth that you see there, and you just heard me talk about, all the constraints and things like that. A lot of that growth is coming from emerging markets, which rely less on those chips. If you look at the growth in mature markets, as I said previously, it's still very much constrained. And then we'll sort of trickle up from there, right? The other thing I want to mention here, and it's on the right axis, if you can see it, it's the little orange dots, is very sneakily, right? What were we talking about before the pandemic? We were talking about electric vehicles, autonomous vehicles, smart infrastructure, and things like that, right? A lot of those, we haven't really talked about a whole lot of late, just because bigger fish to fry, so to speak. But the BEV story, I think, is interesting. Every time IHS has come out with a new forecast over the last 5 or 6 months, the BEV forecast has continued to increase. Part of that's driven, and you can call it chicken or the egg, right? Part of that was driven by OEM announcements and targets and new regulatory targets coming into play. So it's crept up and crept up and crept up. So this year, the forecast is about 5.5% share. By 2025, that share is expected to increase to about 15.5%. And then in 2030, global share is expected to reach 32%. Now, that number will be even higher in markets like Europe and China. I think it still remains to be seen a little bit in the US, depending on how the policy shakes out. But those mature markets are going to carry that. Obviously, in those emerging markets, you're going to have a bit more of a diluted number. But still, 32% is pretty significant. So this is what the new normal looks like, right? We have an industry that has slowly been changing, and I think through the downturn has only accelerated that change. Again, if you look at the announcements that have been made, the number of startups that we've seen, electric vehicles are not only here to stay, they're going to be dominating the market in a very short time. So I thought it would be interesting to say, well, how does that compare with what various OEMs have announced, right? We've seen a lot of OEMs come out with very lofty targets and say, hey, we want to be 100% BEV or 80% BEV by this and this date. So we did some quick analysis, again, leveraging the IHS data. We took the top 12 alliance groups globally, which make up about 80% of production, and said, if they actually hit their BEV targets, what would that share be? We said 32% in 2030 is what the IHS base data tells us. That number would go up to about 41% if everybody was able to meet their targets. Now, again, there's plenty of roadblocks along the way: cost, infrastructure, reliability. A lot of things could happen that would prevent them from getting to those targets. But ultimately, the main pull is going to continue to be that regulatory environment that says you have to have this many vehicles. And China is a great example of they switched from sort of incentivizing consumers to get new energy vehicles to, no, there's going to be increasingly a mandate to get those vehicles. So that's really what's going to be pulling up these numbers here over the next 10 years. Okay, last slide here, and then Rich and I will sit down and have a nice detailed discussion, I'm sure. A couple things to keep an eye on, right? So in this quarter and as we get into 2022, again, we do think, assuming nothing else goes wrong, it's a big caveat, assuming nothing else goes wrong, that we should see some stabilization this quarter in terms of the chip impact, meaning things will cease to get worse. That doesn't mean there won't be downtime announcements, there certainly will be. But we'll continue to feel that through at least the first half of next year and likely most, if not all, of next year. But things to watch, my advice is that take every announcement, every development seriously. Think about what it could mean. Now, again, there's no model or analytics that would have predicted the impact to the industry that we saw over the last 18 months. But I do think it's important to scenario plan to say, look, we don't live in a perfect world. What else could go wrong? And let's start to think about what that impact might be. So at least you're not caught completely flat-footed. And the last thing I want to just mention there is that, again, as I said, BEV share will continue to increase at an accelerated rate. Again, subject to developments, but I think now we're sort of in this position where you're going to see that accelerated uptick, and we as an industry need to be ready for it. Okay, that's it. Rich, let's have a chat. Thanks, guys.
Thanks, Brandon. Some fascinating insights and some stuff that I certainly want to delve into. And yeah, kudos to you for taking a gaze into that crystal ball when no one else would have the guts to do that right now. So
don't hold me to it.
Yeah. Oh, we will. We will. So something that we've been having with our conversations around especially around the tier suppliers, there's incredible pressure. Okay, I'm not educating anyone in the room by telling them that, but incredible pressure amongst the supply chain. Costs are escalating, premium freight utilization is through the roof, well above acceptable levels. How long can the tier suppliers and supply chain, and perhaps even OEMs for that matter, continue in this kind of survival mode? Are we at risk of failure?
Yeah, I mean, I guess the answer is different for every OE, every supplier, everybody up and down the supply chain. Okay. You guys hear me? There we go. Yeah, it's different for everyone, right? And with every crisis that we've seen over the last 10 or 15 years, that's been the question, right? Who's in a good position to kind of weather the storm, and who is most vulnerable? And as I've said with everything, there's no quick fix to this, so we're going to have to figure it out, right? Whether that's support from the top of the supply chain on down, I don't know if that's financial, that's logistical, whatever, we're going to have to weather it out. Sounds like at least through the end of next year, but some things, as some of the earlier panels were saying, are here to stay. The increased price pressures, the lack of capacity, those things don't get fixed overnight. And so that is going to be the new normal, and we're going to have to deal with it. I mean, I think immediately that means higher sustained prices for everybody that ultimately are going to get passed on to the consumer, and they just need to be ready for it. The rest of the stuff, and I give credit to everybody in this room and everybody listening in that's had to deal with it. These are extremely difficult problems to try and solve. And so us as an industry need to be able to work together to try and weather the storm as best we can. So I don't have an easy answer in terms of how long can we last or whatever, but we need to be prepared to at least get through the end of next year, and then we'll see where we're at. But in the meantime, I think there's going to be a lot of moving and shaking.
Absolutely. I mean, talking moving and changing, we're already seeing consolidation, whether it's tier suppliers with mergers and acquisitions, or logistics service providers, consolidations there. Is this going to be a trend that continues?
Yeah, the M&A outlook's always interesting, right? And one of the big things is always, my mic, there we go, is China, and people thinking that there's going to be inevitable consolidation in the industry. And I don't think that's necessarily imminent at this point. I think there's going to continue to be discussions around it. We'll still see M&A activity, but I don't see, at least a near-term acceleration of M&A activity, either on the OE level or supplier level. Now, again, depending on how long the crisis lasts or if other things happen that might accelerate that discussion. But for now, I don't see any abnormal activity in the near term in that front.
Yeah, interesting. And sticking with deals, because everyone loves deals, we've seen a number of special purpose acquisition company deals taking place this year, primarily focused on the EV market and new energy OEMs. There's a growing number of related startups and MA approaches. Is this, again, the best way for them to get to market and production, or is this a risky strategy?
Well, ask me a year, 18 months after those companies go public, and then I'll have a better answer for you. Look, I don't think that's the end of it. I do think there will be more of those, sort of transactions and go-to-market strategies like that through those special acquisitions to go public. But look at the opportunity that I just said. I mean, 32% of our market, electric vehicles, and that doesn't even include the hybridized versions of those vehicles. So you have a huge addressable market potentially at play here, and the market is ripe for disruption, right? So the incumbents are not in such a strong position that they can say we're absolutely going to continue to dominate this market. There are opportunities out there, and we've seen, obviously Tesla is the biggest example, but there are other up-and-comers that have a pretty darn good business model, right? Even if they don't have full scale yet, there's an opportunity. And I think as long as that opportunity exists and people see opportunities, there will continue to be new entrants into the marketplace.
Well, it's exciting to have new players enter and what that means in terms of the opportunities for the supply chain, of course, too. But perhaps sticking with some of the traditional OEMs on the EV side, looking at your numbers, the current percentages of EV production, the leading car makers, there's clearly a way to go to reaching target. And you talked about potential mandates. I mean, just how challenging during this time of continuous disruption, the new never normal, as we've said, are these targets likely to be achieved, or are they starting to become a distant fairy tale?
Yeah, a year ago, if you looked at the targets that had been placed or announced by the OEs, I would have said, that's just for show. There's no way we're going to hit those. But that gap again continues to close, sort of each forecast release, each month, each year, and so I would still say it's a bit of a stretch, but you can no longer say that it's impossible. I mean, again, if you look at the investments that are being made, it's hard to say right now because obviously the ramp up in the near term might look a little bit differently. But if you pick a point in time, whether it's 2025 or 2030, it does seem like we're going to have this much higher number than anybody anticipated prior to the pandemic, because I think that's only accelerated and redoubled efforts in some cases. If you think about the announcements and investments from the OEs to say, look, we're all in on BEV. There's no going back now. There's no other alternative to this. There's no look, and we think a lot of our business at Eaton revolves around the combustion engine, and the combustion engine is still going to be around for a very, very long time. But we have to prepare for the future where we're going to increasingly have to focus on BEV and BEV products and that related technology. So, yeah, it's an aggressive goal, but I wouldn't put money against it. That's for sure.
Interesting. And sticking with that, we've got a question from the audience. So that's a reminder as well for everyone in the room. We have microphones on the side, but also via the app you can ask questions. Of course, our audience tuning in globally can do so via the platform. Addressing this exact point about electrification, what do you think are the biggest industry gaps in preparing for moving to increased electrification? So you've touched on a bit more, but is there something to add?
Yeah, well, there's plenty of gaps, that's for sure. The most immediate thing that comes to mind is obviously infrastructure, or in North America, the lack thereof. Obviously, there's a big infrastructure bill trying to wade its way through Congress right now. I won't get too much into that, but it's critical. And we've talked about it for a long time, that once we hit a critical mass of electric vehicles, you got to have an infrastructure to support it. And we talk about, well, is it the chicken or the egg? But we're getting close to that point where we're going to have to make a serious investment. And we've seen that in Europe. We've seen that in China. So it's a big hurdle to overcome. And then obviously there are the issues around the number of chips, because again, as I said in my comments, a lot more chips are required to go in electric vehicles, so that's not a problem that's going to get solved quickly. And then obviously some of the rare earth minerals that are increasingly required to be in those vehicles. So there are a significant number of challenges that we're going to have to overcome.
And again, you touched on it there on the investments. We're seeing from the announcements last week with Ford, but there are also, of course, others, but announcing new locations with these investments, particularly around electrification. So they're looking like there's a dramatic change in the landscape, especially in North America, be it with battery production or the vehicles themselves. So we're starting to see non-traditional automotive hubs, perhaps Oklahoma, Arizona coming up. Is this, again, another trend to continue? What does this mean for supply chain and the networks that are so well established already?
Yeah, who would have thought, huh? But there's no doubt, the footprint is shifting. And I think it's a couple things are driving that. One, as we've seen currently with chips, but also with battery packs, battery cells, to have a firmer control over the supply chain and more of a, not a complete shift, but more of a build where you sell model, so you don't have to worry about some of the logistics issues that kind of cause that up. You run into different issues, obviously, like in the U.S. if you had rail transport or freight transport, whatever it might be. But that's one, and then sort of control. And so you have a company like like Ford. Okay, so they're localizing. You've got a lot of the OEMs that are partnering with the battery manufacturers. I suspect with the semiconductors, we'll start to see some of the same thing. Localized capacity, more control of the supply chain by partnerships or strengthening relationships to kind of ensure that, hey, next time something happens, and there will be something else that happens, but that we don't have as big of a hiccup. So yeah, the footprint, no doubt, is changing, will continue to change.
Very interesting. And just moving across to, I guess, vehicle sales and perhaps the model. So coming from Europe, we have by and large a higher percentage or a higher balance of build to order versus the US. With vehicle inventories being historic lows, is this going to be a driver to shift models perhaps here in the US?
Yeah, I think like I said, it'll change somewhat. But we've seen this before, right, where now automakers have been able to be extremely disciplined on things like incentives and keeping inventory low because they didn't really have a choice, right? People wanted vehicles, they didn't have them, you don't need to put a lot of incentives on them. I do think, again, we're going to have to rebuild some of that inventory regardless of where demand is at, because 1 million units of inventory or less than 1 million units in the US is extremely low. So I think maybe you'll see a little discipline. We won't get back to that 90-day supply. But we still have a lot of rebuilding that'll happen. We're not going to get to the build-to-order model anytime soon here in the States.
No, would it necessarily be a case of the OEMs want to produce as much as possible, so they're just going to keep filling? They're not going to be dictated to by a kind of a model shift, perhaps?
Yeah, we have to. Look, like I said, I mean, not just inventory, but the fleets that need replenishment as well. So they've got a clear runway, regardless of what demand's like for the next 18 to 24 months. As soon as they're able to build, go nuts, go crazy, because we need the vehicles.
You touched upon China, but I want to delve a little bit deeper, and just for maybe the last sort of minute or two, because it's been such a positive session and not doom and gloom at all. Yeah. Potential challenges and risks coming from Asia that we should be aware of, or our audience should be on their horizons.
Yeah, I mean, with China, it's always going to be a bit of a wild card, right? There's always a number of issues that could come up, and obviously, given the size of their economy, the size of the vehicle market there, the ripple effect would be felt globally, right? So whether it's the Evergrande situation going on right now, and the potential default and the impact that might have on the global economy, or as I mentioned, the sort of restrictions that China is putting on related to emissions for certain manufacturers or in certain industries, we should be concerned with that. And again, as I said, I guess I would kind of end with, take those things seriously. Think about the impact that they could have on your business. Don't just brush it aside and be like, oh, well, we've heard warnings and things like that before. Again, not that you can fully plan for it, but just so that you're not caught completely off guard by some of that. Certainly as an industry, and if you think about market intelligence in the industry, there's a lot of lessons to be learned from what we've gone through and are going through now, is to don't take anything for granted and be able to kind of, at least a little bit around the corner, be able to see based on some of the scenarios you can plan out. You don't know always exactly what it is, and you could have a million what-if scenarios, but I think we need to start sort of taking these developments a little bit seriously, because they're only going to get more complex and more severe as time goes on. It's just the way that our industry's headed.
Yeah, absolutely. And perhaps a final, and kind of joking aside in terms of the level of disruption, the doom and gloom, let's finish on a positive note. So opportunities out there for logistics, supply chain, our audience. Where's the bright lights?
Well, hey, like I said, I mean, it could be worse, right? I mean, we could be in the midst of a recession. Demand could be low, but we're not, right? I mean, despite everything that we've gone through, the overall economic situation looks pretty strong, and demand is right there with it. And so, not to get up on a soapbox and talk about vaccinations and things like that, but I mean, if we can sort out some of the issues that we're going through right now, and we get back to, and again, I don't think there's getting back to a normal, right, where we were at before, that those days are gone. But the new normal can look pretty good, and there's a lot of opportunity out there if you think some of the growing markets, again, electric vehicles. It sounds, based on the conversations this morning, there's a lot of opportunity for all of us to work together a bit more to kind of optimize the supply chain, and we could all come out better for it. So let's keep talking. Let's keep working together. And the future does look bright.
Excellent. Well, that's a great note to end on, and clearly collaboration is key. So I want to say thank you very much, Brandon, for your insights and joining me here. So thank you.